Friends, I'm here to tell you, you don't need a trust fund to grow your wealth. This ain't some get-rich-quick scheme. This is about smart choices and steady growth. I started with a measly $1,000 and turned it into a cool $10,000 in a year. How? Let me break it down for you. We're talking practical advice, the kind that helped folks get back on their feet after the Great Recession. This is about taking control of your financial future one step at a time. And if you're excited to learn, don't forget to hit that subscribe button and give this video a thumbs up so you don't miss more content like this. Now, I'm not talking about playing the stock market like some Wall Street hotshot. You know, those folks who spend their days glued to screens, watching every tick and talk of the market, trying to predict the next big move. It's a high-stakes game, and not everyone comes out a winner. Those fancy stocks are about as predictable as the weather in the mountains. One moment, everything seems calm and sunny, and the next, you're caught in a sudden storm. The market can be just as volatile, with prices soaring one day and plummeting the next. One minute it's sunny, the next you're caught in a blizzard. It's a roller coaster ride that can leave even the most seasoned investors feeling dizzy and disoriented. But don't worry, there's a better way to navigate the financial landscape. No sir, we're going to be smarter than that. Instead of putting all our eggs in one basket, we're going to spread our investments across a range of different assets. This way, we can minimize our risks and maximize our potential for steady growth. We're going to focus on what I call diversified micro-investing. This strategy involves spreading your money across a variety of assets but in small, manageable chunks. It's like planting seeds in different fields, ensuring that at least some of them will grow and flourish. This means spreading your money across a variety of assets, but in small, manageable chunks. By doing this, you can protect yourself from the wild swings of the market. If one investment takes a dip, your whole portfolio doesn't go belly up. Instead, you have other investments that can help balance things out. This way, if one investment takes a dip, your whole portfolio doesn't go belly up. It's a strategy that allows you to sleep better at night, knowing that your financial future isn't tied to the fate of a single stock or asset. Remember, slow and steady wins the race. Just like the tortoise in the famous fable, a steady, consistent approach to investing can lead to long-term success. It's not about making a quick buck, but about building a solid foundation for your financial future. We're playing the long game here, folks. It's about patience, persistence, and making smart, informed decisions. By focusing on diversified micro-investing, we can build a portfolio that grows steadily over time, providing us with financial security and peace of mind. No risky bets, just smart, calculated moves. It's about being strategic and thoughtful with our investments, ensuring that we're not just chasing the latest trend, but making decisions that will benefit us in the long run. So forget Wall Street and think smart. Let's build a brighter financial future together. Diversification is your financial safety net. Think of it like this. You wouldn't put all your eggs in one basket, would you? Same goes for your money. You want to spread it around, minimize your risk, and maximize your potential for growth. Now, there are all sorts of assets you can invest in, but I'm going to share with you the three that worked wonders for me in 2024. Fractional shares in tech companies, specialized ETFs, and REITs. We'll dive deeper into each of these in the next section, but first remember this. Diversification is not about complexity, it's about common sense. Let's talk about my 2024 investment trifecta. This year, I'm focusing on three key areas that I believe will offer substantial growth and stability. These areas are tech stocks, ETFs, and REITs. Each of these has unique advantages and can fit into a well-rounded investment strategy. First up, fractional shares in tech companies. The tech sector has been a powerhouse of growth over the past decade, and it shows no signs of slowing down. By investing in fractional shares, you can get a piece of the action without needing a large amount of capital up front. Don't let the fancy names scare you. Fractional shares simply mean you can own a small piece of a big company. This is perfect for new investors or those with limited funds who still want to benefit from the growth of major tech companies. This just means owning a small piece of a big company. You can start small and gradually increase your investment as you become more comfortable and confident in the market. Think Apple, Amazon, Google, the big players. These companies have a proven track record of innovation and profitability, making them attractive options for any investor. You don't need thousands to get started. With fractional shares, you can begin investing with as little as a few dollars. This makes it accessible for everyone, regardless of their financial situation. Some platforms let you buy in with just a few bucks. This means you can start building your portfolio without waiting to save up a large sum of money. It's a great way to dip your toes into the world of investing. Next, we have ETFs, or exchange-traded funds. ETFs are a fantastic way to diversify your investments. They pool together various assets, such as stocks, bonds, or commodities, into a single fund that you can invest in. These are like baskets of stocks, bonds, or other assets, all bundled together. This bundling reduces risk because you're not relying on the performance of a single asset. Instead, you're spreading your investment across multiple assets. They're a great way to diversify your portfolio without picking individual stocks. This can save you time and effort, as you don't need to research and select each stock yourself. Plus, it provides a level of stability, as the performance of one stock can offset the performance of another. I focused on specialized ETFs in sectors like renewable energy and artificial intelligence. These sectors are poised for significant growth in the coming years, making them exciting areas to invest in. Finally, we have REITs, or real estate investment trusts. REITs allow you to invest in real estate without the hassle of buying and managing properties yourself. These bad boys let you invest in real estate without actually owning property. They pool together funds from multiple investors to purchase and manage income-generating properties, such as office buildings, shopping centers, and apartments. Think of them like landlords, collecting rent and passing on profits to investors. This can provide a steady stream of income, as REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. A great option for passive income. By investing in REITs, you can enjoy the benefits of real estate investment without the headaches of property management. It's a smart way to diversify your portfolio and generate consistent returns. Slow and steady wins the race. Now, I didn't just dump my entire $1,000 into these investments all at once. Remember, slow and steady wins the race. I committed to investing a fixed amount every month, rain or shine. This strategy is called dollar cost averaging. It's a fancy way of saying you buy more when prices are low and less when they're high. This smooths out your average cost over time and helps you build wealth consistently. Discipline is key here, folks. Treat your monthly investment like any other bill, non-negotiable. You'll be surprised how quickly those small contributions add up. Don't put all your eggs in one basket. Remember the eggs in basket analogy? It's back. This timeless piece of advice is crucial for anyone looking to build a resilient investment portfolio. Diversification isn't just about spreading your investments across different asset classes like tech, healthcare, and real estate. It's about creating a balanced mix that can weather various market conditions. ETFs and REITs are great tools for diversification. They allow you to invest in a broad range of assets without having to pick individual stocks. It's also about diversifying within those asset classes. For example, within the tech sector, you shouldn't just invest in one or two companies. Instead, consider spreading your investments across a variety of tech firms. Within tech, I didn't just pick one or two companies. I looked at the market trends, researched the companies, and spread my bets across a handful of promising players. By doing this, I minimized the risk of any single company's poor performance dragging down my entire portfolio. The same goes for ETFs. I chose a mix of sectors to minimize risk. This way, if one sector underperforms, the others can help balance it out. Think of it like building a strong house. You wouldn't rely on just one material or one part of the structure to keep it standing. You need a solid foundation, sturdy walls, and a weatherproof roof. Each part of the house plays a crucial role in its overall stability. Similarly, each element of your diversified portfolio plays a crucial role in protecting your investment from market storms. By spreading your investments, you create a safety net that can help you navigate through financial uncertainties. So, remember, don't put all your eggs in one basket. Diversify wisely, and you'll be better prepared for whatever the market throws your way. The snowball effect of compound growth. Now let's talk about the magic of compound growth. This is where your money starts working for you, earning interest on interest. Think of it like a snowball rolling downhill, getting bigger and bigger over time. The longer you let your investments compound, the more powerful the effect. Even small starting amounts can grow exponentially over time. This is why it's so important to start investing early and stay consistent. Remember, time is your greatest asset when it comes to investing. The earlier you start, the more time you have for your money to grow and compound. Lessons from the trenches. My journey from $1,000 to $10,000 wasn't always smooth sailing. There were bumps along the way, market dips that tested my resolve, but I stuck to my strategy, kept investing consistently, and rode out the storm. The key takeaway? Don't panic when the market throws a tantrum. Stay the course, trust the process, and remember your long-term goals. Investing is a marathon, not a sprint. And most importantly, never invest more than you can afford to lose. This ain't about gambling, it's about building a secure financial future. Tools of the trade. Now you might be wondering, what platforms did you use to make this happen? Well, I'm happy to share my tools of the trade. For fractional shares, I use platforms like Robinhood and Stash. These platforms make it easy and affordable to buy pieces of big companies. For ETFs, I stuck with reputable providers like Vanguard and Fidelity. And for REITs, I explored platforms like Fundrise and Realty Mogul. Remember folks, do your research before choosing a platform. Look for low fees, user-friendly interfaces, and a good track record. The future is bright, invest in it. My $10,000 is just the beginning. I plan to keep investing consistently, diversifying my portfolio, and letting the power of compound growth work its magic. Remember folks, the future is bright, but you have to invest in it. Start small, stay consistent, and don't be afraid to learn as you go. There are tons of resources available online and in your community to help you make smart financial decisions. So, what are you waiting for? Take control of your financial future and start investing today. If you enjoyed this breakdown of my journey from $1,000 to $10,000, make sure to subscribe and hit that like button. I'll be sharing more strategies and tips to help you reach your own financial goals. And if you have any questions, drop them in the comments below.